Thanks for tuning in to this episode of the Resilient Advisor Show. My name is Jay Coulter, and joining me today is Kevin Simpson of Capital Wealth Planning, and we are going to go deep on covered call strategies. Kevin is the Chief Investment Officer of Capital Wealth Planning, a firm with deep expertise on covered call strategies. And I tell you, one of the biggest problems I see in the advisor marketplace today is trying to find yield for near-term retirees and existing retirees. And I believe that covered call strategies can help mitigate some of that problem. Kevin, we're going to go deep on covered call strategies, beginning with the end in mind. We're going to talk a little bit about your ETF DIVO and your separately managed account EDIP as we talk about covered call processes and strategies. But if somebody were to buy into the process of adding covered calls to their practice, which strategy makes the most sense, the ETF or the SMA?
Well, Jay, first of all, thank you so much for having me. It's always a pleasure to be with you, and it's exceptionally fun when you can actually hear me. The real difference between accessing a separately managed account versus a packaged product, I think, so often comes down to advisor preference. There are tremendous advantages, I think, from an SMA standpoint, from a transparency take, because obviously you can see every transaction we make, you can see every holding you have in your brokerage account. The exchange traded fund, we manage it in an identical fashion. We treat it just as any other account that we manage, but you do have the packaged product. So you're not seeing the nuances of every single thing that we're doing day to day. But from an entry point, typically the separately managed account is going to have a higher minimum as opposed to the access point to invest in an ETF. So our minimum on the SMA at most firms is $250,000, probably works best around $300,000. And having the ability to purchase an exchange traded fund that trades around $30 a share gets you a 100 share position for as little as $3,000.
Yeah, so really advisor preference, they're going to be getting the same strategy. So as we walk through this process, it's going to be identical. Is that fair? 100%.
The correlation between the two is about 98% correlation. The only reason there might be a difference is, again, we've got money coming into an ETF. It's not as problematic as an open-end mutual fund, which I've managed in the past, but you still have some timing differences in building those portfolios during ETF creations. And if I sound like I know what I'm talking about, I apologize, because I really don't.
That's why I love having you on, Kevin. You're honest about what you don't know, and you go deep on what you do.
I have one skill set, Jay.
Well, Kevin, given that advisors are struggling to find that income for their clients, why is right now, and we're recording this at the end of September 2020, a good time to look at covered call strategies?
Well, I always think that it's a good time to look at covered call strategies, but the truth is that there are instances in which it's a heck of a lot better. And from the standpoint of a client perspective, especially if you're retired or close to retirement, or if you're a financial advisor that focuses on retirees, a near zero interest rate environment and a near zero interest rate environment for the foreseeable future, as Federal Reserve Chairman Powell said, we've got 3, 4, 5 years of this. How do we get income for clients? And more importantly, how do we get appreciating income, which is a whole nother topic?
Yeah. All right. So your firm's two solutions, the ETF DIVO and the SMA EDIP. So we've already decided that they're run the same way. They're both rated 5 stars by Morningstar. Let's start with the SMA EDIP. Could you walk us through how it's constructed? And I'm going to throw a chart up from your firm that walks through the process, because I found in my research of this strategy, this was a really impactful way to understand not only your process, but the value it would bring to the end client.
Sure, Jay. I think more importantly than anything else, I don't look at this as a covered call strategy, quote unquote. It's a core equity income portfolio. Most important is what we're investing in. Covered calls are great. It's fun to talk about. But most important is, where's my money? And how we construct the portfolio is very simple. We look for great companies that have a long-standing history of having taken care of their shareholders. We define that in large part by looking for companies that pay dividends And we want companies that have a history of increasing dividends. And then even more importantly is we want a company that has increasing earnings to be able to pay for the dividends.
That makes it more beneficial, doesn't it?
Yeah. We don't want to be leveraging and borrowing to pay a dividend. And believe me, there's a lot of companies that do that. So our universe is primarily the S&P 100. We can dip into the S&P 500 if we need to, but 99% of the time you're going to see S&P 100 dividend growth. We don't need high dividend. It's not a deep value play. And we don't have a set minimum for for dividends. We want companies that are increasing dividends. It's about a 2.5% to 3% cumulative dividend yield on the portfolio. And then over a 5-year history, we're looking for 10 to 15% of dividend growth. In fact, in the past quarter, Jay, 5 of our stocks actually increased their dividends. And think about it. I mean, in the wake of a global pandemic, an economic shutdown, everything else that's happening in history of, I think, it was the worst GDP print ever. 5 companies increased their dividends. So that's really important from that increasing income stream over time. So once we build the portfolio universe, we filter it down so it's well diversified among sectors. We want exposure to each of the 10 traditional sectors of the S&P 500. Before they added real estate, although we're an S&P 100 universe, we still like that rules-based process. Everything we do is rules-based. We follow 3 R's: rules, risk, returns. We're talking right now about the rules. So you've got a portfolio that's not subject to market timing. It's not subject to sector overweighting or underweighting. And most importantly, no matter what our conviction in a stock, we put a 5% maximum weighting on any company that we own. So we're going to have between 22 to 27 stocks on average, and they're going to be household names that for the most part, all of our investors are familiar with.
In fact, I've got a screenshot here of the holdings as of the end of June. Again, I encourage advisors to do your own research and look at current holdings, but the snapshot probably looks pretty similar. Brand names that all your clients have heard of, that you've heard of in a portfolio. And this is before the covered call selection process. Kevin, what stood out to me, and the question I have, is I noticed utilities, real estate, and materials, you only have one holding. How are these decisions made from a sector standpoint?
Yeah, so if we go back to that S&P 500 sector weighting before the 11th sector real estate was added to it, and they made some other changes, but when we built the portfolio, the construction was framed on this idea that you've got a rules-based process for everything, including that sector weighting and asset allocation. That way, we're always going to have some exposure. And fortunately, you're not overweighted in utilities there. But real estate is not a sector we have to own. We do own Crown International. It's still Crown Castle International. It's still a stock in the portfolio, but it's a cell tower, not a residential apartment building. And we think of it a little bit as a 5G play, but it's been a good holding for us. What I love most about this is that, again, you're getting a rules-based approach. It's not up to the manager to say, well, we love technology. And sure, if we had done that, technology did really, really well for a while. Recently, it's had a little bit of a pullback. We want predictable outcomes. If we have a rules-based weighted portfolio, we want to attract 80 and capture 80 to 90% of an up market. Utilizing covered calls, we submit that we're not going to capture all of the upside, but we use options and covered calls specifically to help modestly buffer the downside. If we can be participants in only 65 to 75% of a down market, we think that that's way more important. If you can manage risk, if you can manage the downside, we believe that over time, the upside will always take care of itself.
One thing that stands out to me on this slide is the 5-year dividend growth rate. I mean, look at Crown Castle that you just mentioned. I mean, 20% 5-year dividend growth rate from a boring company like Crown Castle.
Yeah. And that's what I love also about the fact that you don't have a minimum threshold for dividends. We own Visa and Nike and Microsoft and Apple, and Crown Castle International has a good yield, but it's that growth that's so important to us, and growth for the right reasons.
Mm-hmm.
Dividend growth.
So talk about the covered call overlay and the execution strategy there, and just what advisors would need to know should they allocate to this strategy in their portfolios.
Yeah, most importantly, it's the portfolio construction, and the dividends take precedent over options. As I mentioned before, we use covered calls as a risk mitigation technique. We want it to modestly buffer some downside. And I was having conversations earlier this week where I would say modestly, and I'm always thinking, in a 7% interest rate environment, if we can generate 2.5% to 3% in dividends, that's modest. If we can generate 2.5% to 4% a year in call premiums, and we're very frugal about when we write calls. It's very tactical. That's still a modest number. But then the conversation was going on with this advisor, and he said, well, if interest rates are at zero, 2.5% to 4% in option premiums is far from modest. And when you put them together and you look at 5 to 7% cash flow, it's a very, very appealing concept for financial advisors that are looking for income with that type of transparency. Now, we're still stocks. It's not a CD at the bank that's going to be insured. But I feel very comfortable with the high quality names that we have, that dividends and a combination of option premiums can represent a portion of an income allocation, equity income, of course.
Yeah, well, contrast that with what we're seeing in treasuries today. I mean, I believe my screen showed me 65 basis points on the 10-year. Again, as we record this here in September of 2020, you're not going to be able to make it through retirement on 10-year treasuries. You have to look for other sources of dividend income.
Yeah, and I think knowing what you own is super, super important.
Yeah. So it's like you've listened to the show before. Got to know what you own and why you own it.
Well, it's my favorite show, Jay. I don't miss an episode.
Of course it is. Of course.
I with you every day.
All right. So let's take a look at some performance returns. First, this is from Y Charts. It shows the SMA performance. I'm just throwing this up here. So viewers, I want you to know Y Charts has released SMA data on the platform. It's incredible if you do A, any work in the space with SMAs, or B, find yourself in competitive situations where you need to differentiate your value proposition. So please check out the Y Chart SMA data, and their free trial is enough time to get really, really deep on the platform. But Kevin, I'm going to pull up the shot that I received from your team on performance going back to 2013. Give us your thoughts here. And that's the biggest softball question I've ever given a guest.
Well, I would say, who cares what I did in the past, Jay? What am I going to do tomorrow?
Yes. I should have known you would have an excellent response to such a softball question.
The performance is excellent, and it's a symptom and it's a result of our 3 R's: rules, risk, returns. If you follow the rules and you manage risk, the returns they will speak for themselves. And in each of those instances, in strong up markets like 13, 17, and 19, we had great returns. We didn't outperform the market, but we captured most of it. And we did so on a risk-adjusted basis that we're exceptionally excited about. I'm far more proud about 2018 and 2020, where you didn't see just complete green flashes across your television every 5 seconds, and how we managed a 2018 and a 2020. And even before the Enhanced Dividend Portfolio came into existence, we have a predecessor strategy that we still run. And 2008 and 2009 and 2020 are the years that we're most proud of.
Yeah, the downside protection, as I'll show you guys in the analytics, in the research I did, really are impressive. A lot of that has to do with having dividends in the covered call overlay, but also the security selection, which I think has been a theme here during this interview. Is that a fair assessment on my part? I don't want to put words in your mouth.
It's so much more important than the covered calls. We don't run a systematic covered call program. We're not writing covered calls on every position all the time. We go through a very definitive process all the time, but it gives you instances in which you've got lots of covered calls written, like happened in April of 2020, and back up to December of 2019, we had no covered calls written. So far more important than the covered calls is the construction of the portfolio and the underlying holdings, because that's where you generate most of your return. And again, to us, dividends are more important than option premiums.
Excellent. Kevin, let's put a spotlight on the ETF, DIVO. Whenever I go and start doing research on an ETF, I pull up my ETF action tool. And the reason I like the ETF action tool is it enables me to go and get just a different lens on ETFs and compare it to what's in the marketplace. What I'm showing you right now on the screen is a list of overlap with different ETFs out there. Some of them made sense to me that I thought there would be significant overlap, but one really stands out is the fact that DIA has a 56% overlap with the holdings in your portfolio. I thought DVY would, which I understand now as we've gone through this interview why that might be, but I'm curious your thoughts on why DIA has such a high overlap.
I mean, we invest in phenomenal American companies. And although there's been some turnover at the Dow recently, high quality never goes out of style. The names might change occasionally. We used to own Boeing in the portfolio. We used to own General Electric in the portfolio. I think it would be a long time before either of those ever came back in. But the concept of looking at high quality and looking at earnings and earnings growth and forecasting kind of appreciation of dividend yield and relative earnings, it's very symptomatic of the Dow because of the nature of the high quality. Just because something is high quality doesn't make it boring.
That's exactly right, especially during challenging times.
Well, I've met a lot of very successful and wealthy investors in my time, Jay. Tons. I have only met a small handful of wealthy and successful market timers and traders.
That's the money line of the episode. That's exactly right. Exactly right. Maybe we should just shut it down now. That was perfect because it's the truth. All right. So, Kevin, whenever I'm looking at a strategy and considering it for inclusion in a portfolio, I go and I stress test it. I take it to Y charts and I look at it during different time periods. I don't like stress testing against the coronavirus drawdown because that is just not going to happen again with that type of drawdown. But it is compelling to look at today. And if viewers notice that the Amplify ETF DIVO held up as the markets were pulling down, you had less drawdown in portfolios. I also go and put it against another time period of high volatility back in 2018. And Kevin, you had referenced this earlier, but the ETF DIVO did a really, really good job holding up during periods of high stress. Kevin, what do you attribute that to?
It's a combination of the dividends, which are really important, inherently a little lower beta in our names, and the fact that covered calls work best when we need them to most. And when volatility is higher and markets are in a little bit less of a certainty period, the premiums will be more attractive and we'll be able to harvest that volatility. And I think that was evident in 2018, and certainly it was evident in the first half of 2020. I mean, the premiums were fantastic and we needed them to be.
Yeah, absolutely. And listen, the market has noticed. So I'm going to pull up a screenshot right now, going back to the ETF action tool, and you can see the inflows into the ETF just in the past 60 days alone. I know that you're regulated by what you can say. I'd love your thoughts, though, on why you've seen inflows into this strategy the last 60 days.
I think it was 60 days ago, Jay, that I was on your podcast rolling out this coming out party, the debutante, if you will. Yeah. So we attribute 90% of that new business to you. Thank you.
Perfect. So that just means we need to have you on about once a quarter, and that will just help what you're trying to do, right?
I don't want to scare away your viewers, but happy to come on anytime.
Oh, that's awesome. All right. So when I'm building a portfolio for clients, and my clients are financial advisors that are looking to find ways to better systematize their investment process, if I'm looking to add a security, there are a couple of things I look for. As I look at DIVO, looking at the Sorrentino ratio, which is a measure of risk to the downside as opposed to just pure analyzed volatility, you can see DIVO held up very, very well against DIA. In addition, if you look at the risk-reward ratios, looking at the 1 year and the 3 year returns, the upside and the deviation really speak to the opportunity to get extra return with less volatility if you leverage the DIVO ETF in your strategy. So the exercise that I go through at a high level before we go deeper is taking a standard 60-40 portfolio and then taking the ETF in question and carving out a 10% allocation. So what you're looking at right now are the analytics of a portfolio that is 55% the S&P 500, 35% the AG, and then 10% DIVO. And what you can see from the analytics of the portfolio is it increases the yield, lowers the volatility, and it only increases the cost of the investment portfolio from 14 to 18 basis points. If you're looking to add income to your investment portfolio, I suggest taking a look at the DVIO ETF. Kevin, I love having you on the show, and there's one reason why.
I have a dog in my lap during the whole broadcast and no one knows?
You're the most entertaining, engaging guest I've had that also manages money. I really appreciate you coming on. If you ever want to come back on, I love having you. You add nothing but value to the audience, and we'll have you on again.
Thanks, Jay. Thanks, everyone.